Welcome to Smart Stock Watch, your go-to channel for in-depth financial analysis. Today is October 14th, 2025, and we're diving into Wells Fargo's latest earnings report for the third quarter of 2025. Joining us is John, a senior analyst from Smart Stock Watch. John, thanks for being here.
Thank you for having me. Wells Fargo has been making significant strides in its financial performance, and I'm excited to discuss their latest results.
Revenue and profitability overview. Let's start with the top line. Wells Fargo reported a revenue of $21.4 billion for Q3 2025, which is a 5% increase from the previous year. John, what are the key drivers behind this growth?
The revenue growth is primarily driven by a 2% increase in net interest income, reaching $12.0 billion. This was supported by fixed-rate asset repricing and higher loan balances. Additionally, non-interest income saw a 9% rise thanks to higher investment advisory fees and brokerage commissions.
And how did this impact their profitability?
Wells Fargo's net income for the quarter was $5.6 billion, translating to an adjusted EPS of $1.60, which beat the analyst forecast of $1.55. This indicates strong profitability, bolstered by both revenue growth and effective cost management.
Operational efficiencies and future outlook. Wells Fargo has been focusing on operational efficiencies. Can you tell us more about their current efficiency ratio and expense management?
Absolutely. The efficiency ratio stands at 65%, which reflects their ongoing efforts to streamline operations. Non-interest expenses rose by 6% to $13.8 billion, largely due to higher severance and revenue-related compensation expenses. However, the company is committed to managing these costs effectively.
What can we expect from Wells Fargo in the coming quarters?
Looking ahead, Wells Fargo expects net interest income for 2025 to be roughly in line with 2024 levels, around $47.7 billion. They also anticipate non-interest expenses to be approximately $54.6 billion, slightly higher than previous guidance due to increased severance and compensation expenses.
Credit quality and capital position. Credit quality is always a critical aspect for banks. How did Wells Fargo perform in this area?
Wells Fargo reported a provision for credit losses of $681 million, with net loan charge-offs totaling $942 million. The allowance for credit losses decreased by 3%, reflecting improved credit performance. Their CET1 ratio remains strong at 11.0%, indicating a solid capital position.
And what about their capital return strategy?
Wells Fargo returned $6.1 billion to shareholders through stock repurchases, reducing common shares outstanding by 6% from the previous year. They also increased their quarterly dividend to 45 cents per share, demonstrating a commitment to returning value to shareholders.
Key takeaways. In summary, Wells Fargo has delivered a strong performance in Q3 2025, with revenue and earnings exceeding expectations. Their focus on operational efficiencies and a robust capital position bodes well for future growth. John, any final thoughts?
Wells Fargo's strategic initiatives and strong financial metrics position them well for continued success. Investors should keep an eye on their expense management and credit quality as key indicators of future performance.
Thank you, John, for your insights, and thank you to our viewers for tuning in. If you found this analysis helpful, please like, share, and subscribe to Smart Stock Watch. We'd love to hear your thoughts on Wells Fargo's performance in the comments below.